Hello everyone, Greg Martin, the Entrepreneur's Banker here, and welcome to the next episode of Selling Your Business 360, a full circle view of your exit. Today we're talking with Nathan Green, who is the founder and principal of Spirit Advisors, a boutique mergers and acquisitions firm. And while he focuses a lot on the construction industry, I've worked with Nathan personally on a couple transactions where we have helped an entrepreneur exit their business. And he is just such a wealth of knowledge that I know that I wanted to have him here. Now, I realized that we've already had one mergers and acquisitions broker earlier in this series, but this is such an important member of your deal team that I thought that it'd be really great to have another perspective from a different broker. So I hope that you enjoy this episode, and I hope that you connect with Nathan.
Well, everyone, I cannot wait to introduce you to my guest today. Nathan Green is the managing director of Spirit Advisors, and he's a great friend of mine, but he's also a great colleague that we have worked together with a lot of business owners, a lot of entrepreneurs. And what I'm most impressed about Nathan is that he's a man of God, but he also wants to make sure that he is serving his clients and putting the clients' goals and objectives first and foremost. And as he's walked with clients and helped them with some of the clients through some pretty difficult situations, but he's been a great advisor to them and a great sounding board. And he's also helped numerous clients with what we're going to be talking about today, with actually exiting their business. Spirit Advisors is what I would consider a boutique M&A firm, and Nathan's got a lot of experience in the field, and it's from this broker perspective that we're going to be talking to Nathan today. So Nathan, thank you so much for joining me today. Thank you for sharing your wisdom, and we really look forward to learning from you.
You're welcome, Greg. Thanks for having me on the show.
Well, let's jump right into it. Tell us a little bit about your background. I know I didn't do it justice, but so what got you into the mergers and acquisitions world, and what type of industries do you work in? Do you focus on?
Sure. A little bit about myself. I have an educational background in accounting and a little bit of finance as well. About the last year of my college, I stumbled across a few books that were written on Warren Buffett and became real interested in the acquisition process and how to determine value and how to even define what intrinsic value is. So I started reading those books in college because I had friends and roommates that were interested in those things. And so after spending 3 years in the auditing field, I started trying to get into the M&A world, and moved back home to North Dakota, which is where I'm originally from, back in 2006. And shortly thereafter, I started working for a company called Knife River, which is one of the largest American-owned construction companies in the world, and was on their acquisition team for about 6 years, and then spent 3 years in the oil and gas industry, and then got back into the mergers and acquisition business after I helped an owner that I worked for sell his company. And most of what I focus in now is the same industries that Knife River Construction operates in, which would basically be sand and gravel, asphalt, heavy highway construction, ready mix concrete, and then some of those businesses have various retail components like landscape and building materials or precast concrete products.
So companies that have a very stout balance sheet, there's a lot of equipment, there's a lot of moving parts, there's a lot of receivables, a lot of payables that are coming through that. So how you negotiate that in the sale process, I can't wait to kind of hear your aspect from that. But before we jump into that, let me ask you, in your perspective of helping as many entrepreneurs that you have helped through the mergers and acquisition process on both sides, both with selling and with buying, what is can you describe a successful transaction?
Yeah, I think one of the most successful types of transactions you can have is where you have one of these companies that I mentioned before that's wanted by strategic buyers, and for the most part they have their internal house in order. And I think if you have those two things, that makes for a very very high likelihood of success.
Okay, so let me dig in that a little bit. You said that you've helped some clients with strategic buyers. What are different classifications that you would say different buyers fall into?
Sure. So I think there's two main types of buyers that I normally see. One is a strategic buyer, and the other is a financial buyer. In the case of a strategic buyer, what they're usually looking to accomplish, they're usually in the same industry as the target is in. And so you hear this fancy term that's called horizontal integration. So
Hmm.
basically what they're looking to do is leverage their in-house resources, their in-house scale, management team, and then they like to find targets that they can acquire, and either the other fancy word is bolt on or tuck into those existing operations. And then they like to leverage cost synergies from their scale, and then they also like to try and find revenue synergies where possible at all. And then on the flip side, there's financial buyers, and we spend most of our time working with strategic buyers, just because that's typically where we can get the most value for our clients, and that's
Hmm.
also typically in terms of capacity to do a transaction. There's not a lot of financial buyers for the reasons that you mentioned. It's very capital intensive. There's a lot of inventory and working capital requirements. So the ability for someone other than a strategic buyer to complete a transaction is lower than it is with a strategic buyer.
And an entrepreneur that has built their business for 30 years doesn't need to practice in selling it. They want to go through, they want to set clear objectives, and they want to sell it. So you have to be realistic of who really can acquire the business. So talk to me a little bit about the engagement process with you, a broker. When should an entrepreneur engage you, and then what do you walk them through in order to prepare them to say, hey, I'm ready to sell?
hmm That's a great question. I think ideally an entrepreneur would engage us when they're starting to think about selling, not when they actually have decided they want to sell and they want to sell 6 months from now. So
Okay,
I
so
think the
6 months
most
is not enough time for you to work your magic.
it's possible. We've done it in the past, but as we'll get into as we answer more of these questions, I think the more that you can prepare yourself in terms of doing reverse due diligence on yourself as a company. So I think that's something that needs to be done ahead of time, where you as the seller and your management team, you would look at your own business as if you were going to acquire your own business, and you would answer the questions, what are the things that would give me the most pause for concern?
Mhm.
What are the issues that I see with my business? And then hopefully you would address as many of those as you can before you go live with the process.
Okay, so how long? Let's assume that the books are clean, and the compensation or the money that the owners take out of the business is very clearly documented, because I've heard throughout this entire series everyone has said, have good books, have clean books, have good financials, make sure that that it's all accounted for. So let's assume that that work's already done and you don't have to go through the pain of clawing back 3-4 years of tax returns and being like, well, I know I told Uncle Sam this, but really as a seller, you need to look at this, as the buyer, you need to look at this. Um, how long does that or reverse due diligence, I think you called it, how long does that typically take?
I think that's something that could be done in 3 to 6 months.
Okay. And
Yep.
what are some things other than the financials that you look for through that reverse due diligence, and then probably is very applicable for the actual sale process as well? What type of documents and things do the entrepreneurs need to start pulling together, have prepared, have documented?
Yeah, that's another good question. In our industry, one of the things that's very important is permitting. Having stormwater permits, air permits, mining permits, a reclamation plan. Those are things that I would definitely look into to make sure that you're in compliance with all of your permit conditions. And if not, you want to make sure that you understand what it takes to become in compliance. And then you also need to understand the transferability of those permits. So For example, an air permit or a conditional use permit, in a lot of jurisdictions, those will go with the property owner or the property operator. So in terms of transferability, the new acquirer would have those permits transferred. In other cases, those have to be assigned and approved before they can be transferred. And then depending on the structure of the transaction, if you're going to do a stock transaction or an asset purchase, that will also have implications on what contracts, what permits, what licenses would be transferable.
Okay, so let's dig into that a little bit, because we've talked with a couple entrepreneurs that have sold and bought businesses. We've talked with we talked with Peyton Holt, who's an attorney in Bryan, Texas, that really kind of gave us the legal perspective of stock purchase versus asset purchase. We're talking with the CPAs to be able to say, how does that impact your tax? But from your perspective, from a broker's perspective, does it increase or decrease the value to do it one way or the other?
I guess the answer to that is when a buyer's looking at doing an asset transaction, it's cleaner for them. There's less liability that they assume, and then there's also the benefit of being able to get tax deductions for the amortization of any goodwill that's on the balance sheet. So in theory, yes, it will increase the value that a buyer would pay to a seller. On the flip side, the seller's take home due to increased tax liability will generally be less than with the stock transaction.
Okay, so that's one thing that you need to walk through with your tax account, your professional, to be able to specifically say, okay, this is not only from a value standpoint, but if you're going to, I guess it works out that an asset purchase is more valuable to the buyer, so they're willing to pay more, and that can maybe offset some of the tax liability than the stock one. But depending on, I mean, in your industries that you specialize in, there potentially could be some liability, some environmental liabilities, some operational liability. I mean, you're dealing with a high risk industry, and so making sure that if I'm going to buy you, I don't want to take responsibility for anything that happened. So I can definitely see how that could be a negotiating point back and forth. What about supplier records, customer records, standard operating procedures? How important are those in the due diligence process?
Those are all very important pieces within due diligence, especially in terms of initially when you're communicating the opportunity to prospective buyers. The more that you can communicate the type of customer, the amount of work that they perform, the markets that they operate in, the funding sources, the outlook for those markets, those are all good things to have up front to be able to communicate to your interested parties. And then once buyers get into the diligence process, that's where they're basically looking into and confirming and affirming the things that have been previously communicated with respect to the opportunity. And then also, I mean, just practical items like customer lists, for example. As you get closer to closing the transaction, the new buyer is going to want to continue selling to your existing customer base. And usually they're going to have different accounting softwares, which means I need to get your customer records into my accounting software so that day one I can sell ready mix concrete to those customers, generate an invoice, and then have remit to instructions on how to get the check paid to the new buyer.
So who handles that? Is that your responsibility as the broker? Is that the seller's responsibility? Is it the seller's accountant's responsibility? Who typically handles? I mean, because that's a little bit of minutia that I can understand is extremely important to the buyer.
Yep.
But who operationally handles that?
Yeah, another good question. So typically we would basically be the middleman or the liaison between the buyer and the seller. And so it's obviously not our responsibility to go in and determine which customers need to be exported, and which documents and records need to be in the export file as well. But essentially, we're going to help manage the information request process, and we're going to review any documents that our clients send over and look for obvious errors or exceptions or follow-up questions that may be asked from those documents, so that we can make the process go more efficiently.
So how does that work in timing? Because it's a really delicate thing. You don't want to go to your customers and be like, "Hey, I'm selling to Jim over here," and then it doesn't go through. And now you've just put doubt in your customer's mind of your reliability and your sustainability. So where does the timing of that type of discussion and transaction happen? Does it happen before the sale is done? Does it happen after the sale's done?
Usually happens the week leading up to the sale.
Okay.
And the reason for that is you're usually negotiating the purchase and sale agreement. The attorneys on both sides are going back and forth, ironing out the finer points of the legal language. And then we're working with the seller on all of their representations and warranties and the exhibits to the purchase and sale agreement. And then someone from the operations team of the buyer will reach out to us and say, "Oh, by the way, we need to get a customer list. We need to get a vendor list." They're obviously less concerned about getting the vendor list in their
Sure.
system before close for obvious reasons. More concerned about cash coming in than cash going out, obviously.
Yep.
So yeah, it's usually kind of a last minute situation, but then it also depends on how ahead of the curve are we on the purchase and sale agreement and the exhibits. And as we have time, everybody will shift focus to different areas of the closing process.
Of the process.
Yeah.
Okay, so let's nerd out a little bit on some accounting, because you talked about the importance of money coming in, money going out. How have you seen accounts payable, accounts receivable handled? You've probably seen it handled a couple different ways, but is there a common practice?
Yeah, I think a lot of that is dictated by the structure of the transaction. So if you're acquiring the stock of a company, you're getting all of the assets and all of the liabilities. So in that case, a buyer's goal is to make determinations or conclusions about how much working capital does this company need to sustain its existing operations, plus or minus the closing date. And so their goal is to have enough working capital, enough receivables, as few payables as possible, enough cash and inventory on the balance sheet so that they don't have to inject additional investment into the company to run the current operations. And typically in that scenario, what you're doing is you're looking to establish a benchmark level of working capital.
Okay.
And I've seen that calculated in a few different ways. Some people like to use a 24-month rolling average. Some people like to use a 12-month rolling average of the net working capital. And then to get a little technical, you would exclude your debt-like items. So line of credit would be excluded from that formula. And in a cash-free, debt-free transaction, you would also exclude your cash from the net working capital formula.
Okay.
So you're basically looking for receivables, inventory, and prepaids less current liabilities,
Gotcha.
excluding your line of credit. So a buyer's looking for a certain level of working capital, and on closing, if you deliver more working capital than what the benchmark is, then there's a positive adjustment to your settlement statement.
Back to the seller. So if you say,
seller.
okay, we need to have $500,000 of working capital in order to sustain operations of this business the second after the transaction, but at the closing week or the closing day, there's $700,000 in the checking account, then that would come back as excess to the seller.
Actually, in that scenario, not to get too anal retentive, but $700,000 of cash would automatically go to the seller because it's cash-free, debt-free.
Okay.
If they had $700,000 of net working capital, meaning AR and prepaids and inventory minus current liabilities, then yes, they would get a $200,000 adjustment for
Credit.
excess working capital. Yep.
Gotcha. Okay. So that's motivation for sellers. And we've heard a couple sellers say that the most difficult part of the sales transaction is that you're running your business as if you were going to continue to own it for eternity, and you're also negotiating to exit it. So you're having to, you're having to keep profits up, you're having to keep everything going. But that's really hard. So let me ask you this, Nathan. How long? So it takes, you said 3 months or so to do the reverse due diligence, and then you put it on the market. What does that mean? Do you have an email that you just blasted out? There's not a Zillow for businesses, is there?
Yeah, there are different websites that are available for businesses. Obviously, there's email distribution lists with all different types of buyers on them. For the most part, we work with strategic buyers. So what we do is we go in and look at the market area, the footprint of the company that's wanting to sell. Then we understand who the most logical buyers would be, and we've had generic high-level conversations with those buyers. We, for the most part, know and understand their strategy and what they're looking for, which markets they want to be in, and we also have a feel for what the multiples they're seeing are in terms of transaction trading multiples, and what they're typically willing to pay within a certain range. And so for the most part, we've done our diligence ahead of time to know who would be interested. And then when we run an auction process, we reach out to those companies that have expressed interest, and we would typically call those like a tier one buyer pool. And that's who we're reaching out to. And we have in that situation, it's very high touch in terms of they kind of get the white glove treatment. We have phone calls, we send emails, we execute non-disclosure agreements, and then we send them an email with the information memorandum, get them access to the data room, and all along we're having conversations with them and understanding what their current thoughts are, what their timeline is in terms of when they'll review the information. And so it's very, very high touch once you get going in the process.
I've heard this process described as the most bizarre dating scenario in the world, where you start out the relationship and you like each other, and this looks like something positive can happen, and then you get into it, and then you just start fighting. The seller is obviously wanting to keep the value up. The buyer is obviously wanting to, as they're getting information and access to the data room and understanding the nooks and crannies of what's in there, they're wanting to drive the price down, and so they're negotiating and fighting, and then at the end they're at the marriage altar. They're there, and the deal is done. So there's got to be a lot of emotion that is through that process. How do you, as a broker, what's the benefit of having somebody like you to walk them through that process, and then to also just be that emotional support, to be like, yeah, most deals die at least once, and but it'll come back. But that's got to be so hard for an entrepreneur. How do you address that emotional component with them?
Yeah, I think even in a secular context, I've heard a viewpoint that said, if you want to be a business broker, you have to kind of be pastoral in nature, which means you're kind of shepherding people's emotions and their hearts and their expectations. So I think, practically speaking, just having us as a middleman in terms of questions that come in and information that goes back to the buyer, I think it's very helpful for us to be able to filter the message appropriately. Not that we would ever hide anything or keep information away from our clients, but just basically not getting too high or too low in the process, having good expectations, trusting but verifying, and helping the owners start to begin to think through, like, what's it going to be like when you don't have a place to come into work anymore, if the buyer has a management team that's going to manage your operation and you're no longer needed. How do we how do we structure kind of a transition period where the seller would have a consulting agreement where they feel empowered and they feel that their opinion is valued, and they can come in and put their fingers on the transition process. Things like that are helpful for owners. They're not going to be in control anymore. They're going to have a new boss. They don't know what their new boss is like. And so it's very important for the deal's sake, to keep things going positively, to manage expectations, and then also filter the message. I've given this example recently because my daughter had a concussion, and the doctors all thought it was a concussion for sure, but they just wanted to do a CAT scan to rule out that there wasn't a skull fracture or there wasn't any sort of internal bleeding. And so when I was talking to my wife on the phone, I filtered the message, just saying they think that it's a concussion. They're pretty sure. They're just going to run a CAT scan to just confirm that it is a concussion. But I didn't go into
you don't say, possible skull fracture to mama. I mean, and again, I completely can understand that. But you've been through this process numerous times. And for an entrepreneur that has built a company for 30 years, this may be the first, maybe the only time that they do that. So, while it's stressful, understanding that this is normal in the process. These types of questions are not a slight against you. It's just them doing their due diligence and them trying to do their job of bringing that price down. So let me ask you this. You talked about part of the value that you bring is that you understand the multiples that is going on in that industry is buying businesses for. Can you explain? And I should mention that you're actually going through the process, which a lot of M&A firms do not have this, but you're actually going through the process to become a certified business appraiser. Is that correct?
That is correct. Yes.
So that's a unique feather in your cap to be able to help your clients with. But how do clients come up with the value of their company? Because especially in your industry, you've got cash flow, but then you also have a lot of heavy assets, a lot of dirt moving equipment, bulldozers, trucks, stuff like that have value, land. In some areas, maybe even like sand or gravel pits. So how do you mesh all of those together to come up with a value for a company?
Yeah, I think one of the things that I'm learning over the years is that there's a difference between being an objective valuator versus being an advocate for value. So the objective valuator, that's something that we perform where it's sort of a rigorous process where we're looking at what are the key value drivers. So your volume, your price, your margin, your capital expenditures, tax rates, all that sort of stuff. And we gather information, we make conclusions about the history, and then we make projections about the future based on discussions with management, market conditions, our knowledge of the industry. And that's more of a rigorous valuator approach. And then also there's the advocate approach. And I think the advocate approach is where you're taking an idea or a concept or a strategy, and you're communicating that to buyers who are looking for that idea or concept or believe that you can monetize or make really good returns or improvements upon what they're already doing.
Right.
And so that's something that we also have to always be looking at and that's where a lot of the multiples come into play, and that's where strategic fit comes into play. But I think it's very helpful for us to give our clients a very healthy dose of reality in terms of how a buyer would look at the value of their business. And that's usually generated off of an internal rate of return. So if I'm going to give you $30 million, what internal rate of return is that going to generate over the next 30 years? And typically when we make a decision about marketing a company, if we look at the objective valuation approach and the value of the business is 20 million, but a seller wants 60 million and they're not taking a penny less, then we know that we have an engagement issue at that point in time.
Gotcha. So, and that's where um, you either educate the seller on what reality is, but I've also seen you step in and say, okay, if that's the price that you want, then it's going to take this, this, and this to get there. So let's put a plan in place to increase your revenue, to increase your margin, to increase your reach, to make you more attractive to the point that you can get to that 60 million. If you want 60 million, then let's put in some work, but it's only worth 20 now. And that's got to be a hard conversation sometimes.
Yeah, it is.
Oh.
And I think in fairness to the entrepreneur, sometimes they can help us reconcile the 20 to 60 gap, and we may not get all the way there, but they know their business better than anyone. And in a lot of cases, they know and understand value as well. And so the better job they can communicate that to us up front, the more successful the opportunity will be.
Gotcha. Well, Nathan, you have shared so much wisdom throughout just talking about the process, talking about the value of having a broker. If you could give, I'm gonna challenge you, one bit of advice to an entrepreneur that is thinking about selling, and maybe they're going to sell in 3 to 5 years. What would that be?
I would say make a plan and execute the plan. And that's very high level, and we could drill into that ad nauseum. But I think knowing your business, knowing the market, knowing who the buyers would be, and then doing the reverse due diligence, and then making a plan, getting the right people on the team, and then staying committed to the plan, staying focused, and seeing it through to completion.
Gotcha. Well, again, thank you so much, Nathan. How can people get in touch with you if they want to learn more, if they want to nerd out on valuations a little bit more or whatever? How can we get a hold of you?
Yeah, email or my cell phone number would be totally fine, and I'm sure you've got that information that you can share.
I'll share that with everybody in the slide after this, and just want to say, like we say with everyone on this series, these thoughts and opinions are mine and Nathan's alone. They do not represent our respective employers or any affiliates or anything like that. Again, Nathan, I really appreciate you joining us today, and I thank you for your friendship and what you do to help entrepreneurs.
Likewise, thank you for your friendship and everything you do.
I learned so much every time that I talk with Nathan, and like I said, just the spirit that he has and the willingness to be able to provide an open and honest conversation to say, okay, here's the pathway towards success, and helping entrepreneurs in their exit to get success, whatever it is that they're looking for. The top 3 things that I took away from Nathan is, one, you've got to have a plan and stick to it. Obviously, that impacted me a lot based on the title of this episode, but really to be able to have someone like Nathan come alongside and say, okay, here's the plan, not only for the immediate operations of the business, but through the exit part of it, and then to actually just stick with the plan and execute on it. 2, you need to understand how your company is valued, and then deal with that accordingly. If you're in an industry where you have large capital expenditures, or you're in an industry that it is more based upon top line revenue, or maybe you're in an industry that is all about bottom line, EBITDA, or free cash flow, you need to understand what your business, how your business is valued, and the multiples that are included in it, and then deal accordingly. If you don't have enough value in your company in order for you to exit, in order for you to hit that number that you need, well, then you need to go back to work and figure out, okay, well, what's it take to get those numbers up higher so that you can have the exit that you want to have. And then 3, you need to know your buyer, whether that be a financial buyer or a strategic buyer. And obviously, just being in the industry that Nathan's in, he deals more with strategic buyers. But really, to be able to understand, how do you market? How do you put yourself out there for a strategic buyer versus a financial buyer? And then how do you find those people? So be involved in networking events, in industry events, and be able to say, okay, there's people out there that are gonna want to buy your company, and it's about you making that connection and going through that. Well, I hope that you have enjoyed this episode as much as I've had talking with Nathan. Like I said, if you are not connected with Nathan on LinkedIn, I've got a link to his contact information in the slide in just a second. Make sure you reach out to him, connect with him. I know that it'll be amazing for you. I hope that you join us next week when we talk with Will Hayes. Will is a certified financial planner with Northwestern Mutual, and Will is that advisor that is going to help you after you exit to be able to make sure that everything is taken care of and that you're able to meet your long-term personal goals. He's one of the great members of the Entrepreneurs Fab Five or your deal team or however you want to have it. So I hope that you join us next time when we talk with Will. Until then, this is Greg Martin, the Entrepreneur's Banker, wishing you to have a wonderful week.